Mortgage-backed securities, MBS, are financial instruments that represent an ownership interest in a pool of mortgage loans. These loans are typically residential mortgages, meaning they are loans taken out by individuals or families to purchase homes. When someone takes out a mortgage to buy a home, they agree to make regular payments to the lender over a specified period, which includes both principal and interest. These individual mortgage loans are then bundled together and sold to investors as securities. The process of creating MBS begins with financial institutions such as banks or mortgage lenders, originating a large number of individual mortgage loans. These loans are then pooled together based on similar characteristics such as interest rates, maturity dates, and credit ratings of the borrowers. The pool of mortgages serves as collateral for the MBS. Once the pool of mortgages is assembled, the financial institution creates securities by dividing the pool into different tranches or segments. Each tranche represents a different level of risk and return for investors. The tranches are structured so that investors with different risk preferences can choose securities that align with their investment goals. For example, investors seeking lower risk may invest in tranches with higher credit ratings, while investors seeking higher returns may opt for tranches with lower credit ratings but potentially higher yields. Investors who purchase MBS receive payments based on the principal and interest payments made by the borrowers in the underlying mortgage pool. These payments are passed through to investors in proportion to their ownership of the securities. However, it's important to note that the timing and amount of cash flows can be influenced by factors such as prepayments of the underlying mortgage loans, changes in interest rates, and default rates. One of the key benefits of MBS is that they allow financial institutions to free up capital by transferring the risk of mortgage default to investors. By selling the mortgage loans as securities, lenders can generate additional liquidity to originate new loans, thereby facilitating further lending and investment in the housing market. Additionally, MBS provide investors with opportunities to diversify their portfolios and potentially earn higher returns compared to traditional fixed-income securities. However, it's essential to recognize that MBS also carry certain risks. These risks include prepayment risk, which arises when borrowers pay off their mortgages early, as well as credit risk, which stems from the possibility of borrower default. Changes in interest rates and economic conditions can also impact the performance of MBS and the returns received by investors. Therefore, investors should carefully evaluate the risks and potential rewards associated with investing in MBS before making investment decisions.